For several quarters, Warren Buffett's Berkshire Hathaway had been filing that they've been confidentially purchasing billions of dollars in a mystery stock. Then just this past week, it was revealed which company he was buying, and that company is Chubb, C-H-U-B-B. The ticker is CB. This is now a top 10 position for the Berkshire Hathaway portfolio. In this video, we're going to talk about what does Chubb even do? Is it, worthwhile for investors to consider piggybacking off of what, Buffett saw? What did Buffett even see here with Chubb? Going into a little bit greater detail, my own preferred investment versus Chubb. So I'm going to talk about a little bit about my own personal portfolio as well. And so this is now around a $7 billion bet for Berkshire Hathaway, and it represents over 6% of the company. So you do have this, the potential for activism of, hey, it crosses a 5% threshold. Will he be, making a bigger move on it? Personally, I would be surprised, especially at the current level. So what does Chubb even do? I go to AI Ticker Chat just for quick summaries of the businesses, quickly understanding that Chubb is a global insurance company. You're talking about commercial insurance, personal, agriculture, reinsurance. That means they're helping insure the insurance companies. They have life insurance. There's a lot of different pieces here, and it's a global insurance company. The reason why this is so important to understand when you have a global insurance company is if you're focused just on one, market. Let's say you're focused on Florida and you're writing just one line of insurance focusing on hurricanes. Well, if you get a monster hurricane, that hits Florida, hopefully it doesn't happen, then your business is in great trouble. So when you have something that's diversified across many different product lines, like they are, and then you have geographic diversification, around 50% of their business is outside the United States, around 50% is in the United States. You're talking about a business that's in literally dozens of countries. You're less likely to have a destabilizing risk. You're even less likely to have a destabilizing event when you have multiple super cat or catastrophes happen because it's spread out across so much. Now, this is now one of the largest insurance companies out there, and to give you some context, because some people say, well, what help me even understand what this is doing, like agriculture. What's agriculture insurance? So that's actually crop insurance and farm and ranch related agribusiness. So there's a lot of sub specialty lines, where you say, oh, I want to protect this. A lot of people traditionally are familiar with like home insurance and auto insurance, but for a lot of businesses, there's a lot of different forms of risk that you want to remove from yourself. Maybe it's some sort of work stoppage. Maybe it's workers' compensation. Maybe it's, what happens if something happens to my property or my plant or my vehicle. So there's lots of different types of, insurance lines. And you can see that it is pretty well diversified. They have the large property and casualty, middle market, so small companies, P&C. You have personal lines, you have agriculture, reinsurance, a lot of different products. And then it goes into even further detail. Maybe you want to talk about cyber, or you want to, protect yourself against some. So if there's a crime related event, directors and officers. So if you have a directors and officers, with an organization, they're going to want to have some sort of liability protection that, hey, they don't get sued if, the company goes off the rails. Okay. So what's that insurance, looking like? And so there's just lots and lots and lots of different types of risks that ultimately companies, large and small, want to push off to the insurance companies. And the insurance companies, it's on them. And, this is a list of just the property, the commercial property and casualty examples of some of the things that they cover. Railroad liability insurance, a lot of different things. That this is a market where they're trying to assess, okay, what's the odds that, this is unprofitable for us? And so this means you have not only a global business, so that way you're less exposed to any given one risk. This also means that you employ hundreds of thousands of risk assessors, which they do, to, size up, did this risk actually happen? If a claim, let's say, occurs after someone, signed up for an insurance policy, like, okay, how do you make sure it's not fraud? So you have a part of your team that'll size that up. Okay, this was legit, this isn't just them looking for some sort of insurance payment. And you also have the, the actual underwriting, we're saying, what are the odds that this turns into a claim? And, it's funny reading enough about Warren Buffett and some of their historical insurance contracts. There was previously, I think it was Mike Tyson wanted an insurance policy. And so this is just sharing an example of how they think about insurance. Like, how do you make sure it's some sort of fair policy? Where I think Mike Tyson wanted some sort of life insurance policy. And the way the contract was structured is that for each fight that he would have, the payout would drop significantly. And so that way the risk that Berkshire was taking on sort of dropped, the longer his boxing career went on. So that, it's a lot of this is just sort of problem solving. A lot of this is understanding sort of what are the base rates for events to happen. Like, okay, let's say super catastrophe earthquakes happen every 100 years. Is the market pricing in that it's a 1 in 100 year event, or is the market pricing in that it's a 1 in 20 year event? Because if the market's pricing in is closer to 1 in 20, then it's a lot, it could be a lot more interesting in terms of making money from that actual type of event. And so, you're looking at Chubb, and this is just a monster of an insurance company. This is one of the largest insurance companies of the world, $12 billion in premiums. Net premiums are written in the first quarter alone, and they were made an 86% combined ratio on their property and casualty insurance line. That's the vast majority of their business, $10.6 billion of their premiums written out of the $12 billion. And so that means, the 86% rate. So that means after the policyholders had their claims paid out, after the admin costs of, running the insurance expense, after all that, you're effectively talking about a 14% margin, pre-tax margin for the insurance claims. And it'll jump around, it'll move around, but that's going to be one of the key parts for why I think Warren Buffett is interested in Chubb. So let's go through the different, angles for what he saw here with Chubb. I think one aspect is that he looked at Chubb relative to some of the other large insurance companies, and he sees that this purple line is Chubb, this orange line is the peers, including AIG, and I'll talk about AIG in just a second. And you can see that for several years, Chubb's combined ratio, so that means their costs for effectively providing insurance, both from a policy claim perspective as well as administrative costs perspective, is consistently lower than the peers. So when you do this means you're possibly leaner, and two, it means you're probably more conservative in terms of how you're underwriting business, or at least it's better managed. That's what this data would suggest. Okay. And, Berkshire Hathaway is a super large insurance company, one of the largest in the world. So he knows what quality it looks like. I think another key aspect is if you look over a similar time period, the return on equity for Chubb has gone from, effectively high single digits to mid-teens level. A big part of this return on equity for this business is due to the fact that as an insurance company, when you have a customer say, hey, I have this risk, I want to offload it to you, you go, okay, you give me this premium, I'll cover you in case there's an issue. So they give you a premium. The insurance company now has this thing called float. They're sitting on all these premiums, and there's a risk that they might have to pay that out. So they're sitting on these premiums. By and large, with an 86% combined ratio, they're able to keep 14% of that, but a lot of it's going back out in terms of expenses. A lot of it's going back out as claims. So it's not like you can invest that float for super long haul, like I'm going to put that all in equities, all in, GameStop. You can't do that. Regulatory says like, hey, you can't put it all in stocks. So you have to hold a large, liquid portfolio, oftentimes in some sort of bonds, sometimes, stocks or mostly short dated bonds, maybe a couple of years. Well, we've had a period now where interest rates are much higher. You can now get 4.8% plus on your cash. See the link for Interactive Brokers below. That's, where you're getting 4.8% on cash. So as rates have moved higher, if you have a company like Chubb that has tens of billions of dollars in terms of investment portfolio, now what you're talking about is a much higher yield that they can get. So now you're talking about an environment where just because interest rates are higher, the return on equity for this company is also higher. So I think you're also in this new environment of a higher return on equity, really more like a return to normal for what insurance companies can do in terms of their margins. So I think that's a key aspect, and Warren Buffett certainly appreciates float in terms of, in a higher interest rate environment. I think another aspect is actually the management. Evan Greenberg is the chairman and the chief executive officer of Chubb, and he has the insurance gene, clearly, because he's the son of Morris Greenberg, who was one of the top dogs at AIG. Now, you might think, oh my gosh, like, doesn't that mean like Chubb's going to explode? Morris Greenberg was like one of the builders of AIG. No. He was kicked out of AIG, I think in 2005, several years before effectively AIG was writing all the subprime, default swaps, I think it was, credit default swaps that ultimately blew them up. So he arguably would have caught a lot of that because he had been hyper vigilant during his multi-decade career. That's a whole other story. I think this is actually a testament that Warren Buffett believes in management and thinks, man, if anything, he knows, from his family. And I think one of his siblings used to be the head of one of the largest insurance brokers. So, you have it in his family through and through. So I think those are sort of the key aspects that I believe Warren Buffett is considering. So is it worth it for you to consider looking at Chubb? After all, Warren Buffett has just made a sizable purchase. Well, first of all, in full disclosure, this is not financial advice. I don't own stock in Chubb. I own stock in Fairfax, which we'll talk about in just a second. And also just last week, Robin, a premium member of Unrivaled Investing, commented, this is a direct quote, "I'm an extremely happy customer of Unrivaled. The information services you provide to me are invaluable. This follows another subscriber posting on how I'm currently ahead of my investing goals to retire at age 45, thanks to Unrivaled Investing. Consider Unrivaled Investing for compelling investment ideas. Come check it out. I do expect to be raising prices later this summer in the month ahead. So now's the time to lock in the favorable rates, and as regular subscribers know, the not only do you keep this channel going, but you're also grandfathered into the favorable rates as well when you lock it out. So looking at Chubb, looking at the historic valuation, this is price to book value. And that's a super important metric. When you're looking at some companies, it's important to look at free cash flow. Some people look at price to sales, typically when you're looking at a company that's not yet profitable. For insurance companies, you're generally looking at the equity and the market cap relative to the shareholders' equity, because that shareholders' equity, because of regulations, because of, what you're allowed to invest in, you're looking at, okay, how much of a return can you get on that equity? And, it's currently trading around 1.8 times price to book for Chubb. And you can also see, that's historically at the higher end of the valuation here. So I think that's part of the reason. So the first thing, I think that's part of the reason why Berkshire Hathaway, in this quarterly report, they said they had the confidential treatment on Chubb through the end of May. That was an agreement that they had with the SEC, but that they were showing it to us now. I think the reason why is because Warren Buffett's no longer buying at these prices, and I don't think he's interested in buying at these prices. So I think that is the first point, but I think closer to 1 times book value could be a lot more interesting. Now, the rough math, for something like that is it doesn't actually mean that this is terrible. Like there's a reason why he's not selling it. I don't think he is that if you have, let's say, it's able to maintain somewhere between a 10-15% return on equity over time. If the valuation just stays the same, that means your investment compounds at 10 to 15% per year. Let's assume the 15% return on equity gets returned 100% to you as a shareholder. Well, that means at 1.8 times, 15% return on equity, and you're paying 1.8 times, that means you're effectively getting around an 8% yield that can go to you each year. It's not that bad. Like, really, relative to a lot of other things, it's not bad. The challenge is that if you have some sort of situation where the return on equity, let's say, is, teens, and then you see some sort of valuation compression in the future where it goes from 1.8 to 1.5 or 1.3 times. So that is that's the scenario that would hurt you as a shareholder. And that happens with all types of stocks, where you have to balance the fundamental growth with the actual valuation potentially coming in or expanding. Ideally, you want to find something where you have the free cash flow, you have the fundamentals, and you have valuation. They're all expanding. That's sort of like the dream setup. Now, I already mentioned that I own Fairfax Financial. That's my own personal insurance play, and you can sort of see why. I've done actually 2 separate videos on this, and I'm glad to refresh my own numbers on this, just so that way I could see, okay, well, what's Buffett doing versus what am I personally interested in? So Chubb has grown their gross premiums in terms of their insurance business from around $40 billion to around $60 billion over the last few years. So around 50% growth. And the book value per share, because you can't just look at the equity in the business because they might buy back stock, which they're doing, has grown around 30, 40%. 30, 40%. So 50% growth in premiums, 34% growth in book value per share. In contrast, Fairfax has taken market share, growing their gross premiums by nearly double over the same period, and their book value per share has increased by more than 100%. Meanwhile, so I'd say the execution here, at least for the last few years, goes to Fairfax on both the premiums and the book value per share. Book value includes, because you might say, well, wait a second, what's the risk that they're just, they're growing, their premiums too fast and they're, it's going to result in losses for them. Well, that would get incorporated in this book value per share figure, because then you'd start seeing the losses and then it wouldn't be growing as quickly. So here it is on both. I'd argue the key metrics, and you could argue maybe we should be looking at net premiums as opposed to gross premiums. Either way, Fairfax is taking share and outperforming on the book value per share. So on the fundamentals goes to Fairfax, and then on a valuation, Chubb is at 1.8 times versus Fairfax at around 1.1 times. That's adjusted for a couple of small things. But you unadjusted, it's 1.2 times. So I would put this in terms of the thesis, thinking about Fairfax and thinking about Chubb and the general marketplace. Like Buffett a few years ago bought Allegheny. I think it was around $20 billion purchase. I could be wrong. Give or take $10 billion. He bought that around 1.3 times price to book. So Chubb, he was probably doing the same formula, buying around 1.3 times. And so that's, sort of my formula of like, hey, if you see the super investors of the world buying insurance companies, or buying stakes in insurance companies that are well run, that have, and that's the key to this is you can't just say like, hey, this is great. I'm going to buy this insurance company because it looks cheap. Yeah. If you're writing bad policies, it doesn't matter how cheap it is because you can still blow up. So that's the other aspect is that, but Fairfax so far is doing very well in terms of how they're conservatively managing it. So I wanted to share a little bit about my own personal portfolio on this because Fairfax is one of my top holdings. And you can see why sort of with, going through this logic here of on a fundamentals and valuation basis, it seems to be crushing it. And it's also, we're in a new environment, I'd say return to normal, hopefully, where interest rates are unlikely to go back to zero. And so for those companies that are forced to hold large, investment portfolios, oftentimes tied to fixed income, this is a much, much better environment than they've been for much of the last 2 decades. So I hope this video talking about Chubb, why I'm not really sold on it right now, and why I do personally own Fairfax, and sort of the educational understanding of what's going on in the industry has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.